Welcome to the Risk Reversal Podcast, guy Adami, always joined by Dan Nathan. On December 13th of last year, this gentleman joined us probably for the third or the fourth time. That, of course, David Rosenberg, founder of Rosenberg Research. Rosie, how are you?
Well, let's just say that I'm doing better than this freezing Canadian winter that doesn't seem to want to go away. But I set the bar low. But thanks for
the winters don't end. And as you just said to me prior to this show, your Montreal Canadiens are the hottest team in the NHL, and they look like they're going to get a playoff berth for the first time in a while. We'll discuss that later, but obviously an interesting week. And let's start with the Federal Reserve yesterday. I mean, you've been pretty outspoken in terms of what you think should be going on and what you think is in fact going on. Did you hear anything yesterday which sort of galvanized your way of thinking, or did you walk away disappointed?
I wasn't disappointed at all, and I wasn't really surprised. If you go back several months after the election and when the tariff and trade file really started to gain a head of steam, at one of his conferences, Powell said that how he felt about monetary policy making right now. And he said, what do you do when you're in a room that's pitch black and there's furniture, is that you just stay put. You don't walk and then trip over yourself. So, of course, they weren't going to do anything on rates. And the fact that, he was non-committal and basically signaling a wait and see mode, I think is totally appropriate. What I found most interesting was really in the dot plots, and I'm talking about their economic forecasts, because, that actually dovetailed with my view, because let's look and see, what they actually did. And these are just, economic projections with a very wide error term. But they took the real GDP growth forecast or projection for this year down to 1.7% from 2.1. But then for next year, they took it down again from 2.2 to 2.0. So cumulatively, they took down their GDP call by half a percentage point, which is like $150 billion off of their prior GDP guesstimates, call it for the next 2 years. And when you consider that corporate profits over 10% of GDP, you start wondering how we're not going to see analysts starting to cut their estimates more forcefully over the course of the next several months and quarters. The other side of the coin was what they're saying on inflation. So I look at core inflation, the core PC deflator, and no surprise, they took that up from 2.5 to 2.8. I mean, for all the anxiety and angst, they took it up 30 basis points. But then they have it coming right back down to 2.2% next year, which is right where they were, back in December. So it's telling me really two things. It's telling me that the Fed believes that the expected price shock from the tariffs he used the word transitory. I actually, after the miserable experience a few years ago, would have maybe just said brief or short term. I would have found, a different term to describe it. But what happens here is you get the price shock, real personal incomes contract, and with that contraction comes another contraction, which is in consumer spending. And that's what drives underlying inflation right back down again. So their view, when you look at the numbers, is that the tariff shock most likely is going to have a bigger impact on real economic activity than on inflation. And that the impact on the economy, considering that they still trimmed their GDP forecast next year, but had core inflation coming back down to where they said it was going to be several months ago, the hidden message, maybe it's not so hidden, is that the tariff impact is going to have a more lasting effect on the economy than it is on underlying inflation. That's what I took away from it.
All right. So let's stop there for a second. I think we'd all agree. I mean, in terms of their forecastability, it's not particularly good. So for them to sort of forecast the out year for inflation, I think that's more of a hope than a forecast. But I'll give you that for a second. But what you just said sort of harkens back to what almost to the day Jerome Powell said 11 months ago when asked about stagflation, and I know you know this, he said, I see neither the stag nor the flation, thinking it was probably pretty cute and pretty funny, and he probably believed it as well. But what you just sort of described, and by the way, on top of that, I think they raised the unemployment number that they were expecting as well. So, they're talking about a deteriorating jobs market, not horrible, but deteriorating, inflation, which is still a problem, and growth, which is slowing. I mean, that reeks of stagflation to me, or am I just missing the boat here, which is probably the truth?
Well, I don't know. Like if they're anywhere in the ballpark on their inflation call, we're going to go to 2.8. Paul Volcker would have given
Yeah,
part of his anatomy
to be at that level.
2.8. We were, with all deference, we got down to 2.8 back in the mid 80s. We were dancing the hora at the wedding, and now it's 2.8 of stagflation. Okay, sure, run with that. And then they have underlying inflation going to 2.2, which is, God forbid, 20 basis points above target. Now, these are just projections, of course, but there's nothing stagflation in there. The bigger point is the impact on the economy. Now, they just nudged up their unemployment rate forecast, but it's important because it's the first time for 2025 that they're at 4.4%. You go back to the cycle low in the summer of 2023, it was 3.4%. Now, watching the unemployment rate is like a race between watching grass grow and paint dry. But you see, we would have gone up 100 basis points if they're anywhere in the ballpark on the unemployment rate forecast. And all I hear all the time is the unemployment rate is low, the unemployment rate is low, the unemployment rate is low. But it's not the level of the unemployment rate that determines the contours of the economic cycle. It's the change. I could show you countless numbers of recessions back to 1948 where the recession started with the unemployment rate where it is today or even lower. And so they're telling you 4.4. Well, there's a lot of information right there because it would mean that the unemployment rate would have risen by the end of this year by 100 basis points off the cycle low. And when you're looking back at all the previous recessions, okay, we're not going to count the one in early 2020, the COVID one, because that came and went with a blink of an eye, and it was caused by a pandemic, not by anything else. But you go back to the previous 11 recessions from 1948 all the way to the great financial crisis. When the unemployment rate went up 100 basis points, you had a recession 100% of the time, okay? By the way, by the time you're up 100 basis points in the unemployment rate, you've already been in recession for 5 months. That's both an average and it's a median. So the Fed just told you, notwithstanding their GDP forecast, that based on where they see the labor market going, we could actually be in a recession when you apply the past to the present and the future. It could be starting in July. This recession that never came because of a variety of reasons. We had a massive wealth effect on spending for the upper echelons, and that kept the glue going up until very recently. And then you had under Biden's term program spending running at double-digit rates of growth, and now Elon Musk is looking after that. So you have two very solid pegs that prevented the transmission mechanism for monetary policy from doing the work it used to do. I was actually rather amazed that the most Volcker-esque tightening in monetary policy since the early 80s didn't precipitate a recession. I was in that camp, but I underestimated the power of fiscal policy, that we would run 5 years of over 5% deficit GDP ratios, which not even FDR did in the Great Depression of the 30s. It just blew my mind. But the government on the fiscal side was a big reason why that recession was averted. But now that's in the rearview mirror. The wealth effect on spending is now in the rearview mirror. Now you're finding the high-end consumer is now following the low end and the middle class in terms of struggling. And you're certainly hearing that from retailers as well. So that's what I found also when we go back to the first question on what I found interesting from the Fed. The story beneath the story was going to 4.4, bottoming at 3.4, knowing that that has a 100% track record. I'm not going to go and say it's different this time. Maybe there'll be some other positive shock. I'm not so sure. We had a positive shock on the fiscal side that clogged up the recession call. There's no doubt about it, and I've written about that. However, that to me was actually something that was very important in that FOMC meeting. So I don't see the stagflation. If we're going to call stagflation, we used to compare stagflation to the 1970s. But I mean, are we going to get those sorts of inflation rates? In Canada, I'm talking to you from Toronto. The Bank of Canada doesn't hold itself accountable to a 2.000000% target. It's 1 to 3%. Why the Fed never gave itself that flexibility, Lord only knows. But are we really going to say that we're in a stagflationary environment when next year's inflation rate has a shot at 2.2%? And as you said, it's just a projection. I actually think it's going to be lower than that. I would grab 2.2, and then that's not a stagflationary environment.
What about the cumulative nature of inflation over the last 4 years, right? So again, let's say you get to that magic number of 2.0000, we've still seen prices go up dramatically on a cumulative basis. And so if we do have lower growth, which you are projecting, what looks like the Fed is projecting, what about so you're seeing, a lot of pressure on a lower end consumer. You just mentioned you're seeing it on a higher end consumer. Couldn't that be stagflation? I guess who cares about the definition of stagflation, but it doesn't make for a particularly good economic environment. And just going back and looking at the 70s period, the recession that we had and the bear market we had, it just wasn't good for risk assets.
Well, you look, it's very rare, especially looking at the construct of, whether it's the PC deflator or it's the CPI, it's very rare to have prices go down. Prices of goods, they can certainly go down. Say 60% of the index is services, and a lot of those services, by definition, are sticky and non-cyclical in nature, like healthcare services, education services. They don't really move with the business cycle. And when you're talking about stagflation, it's not about levels; it's about rates of change. Everything in economics is about rates of change, as they are in the markets. Like when we look at 4 o'clock at the market close, are we talking about what the level of the Dow and the S&P 500 and the NASDAQ? Are we looking at what it did? When people say, what did the stock market do today? Do you answer them and say, well, this is the level? They'll ask you, what did the S&P do today? Oh, 5,500. Oh, okay. Was it up or down? It's about change at the margin. That's what matters. It's about change. Evolution is about change. Cycles are about change. Life is about change. So it's not about levels. So that's why it's an important distinction when people say to me, well, the price level is still high. Well, I've got news for you. The price level stayed high and even went higher during the entire Volcker period from 1979 to 1986. The price level only went higher. He never brought the price level down. And that was after the fact that prices surged in the 1970s. Prices didn't reverse in the 1980s. What happened was that the inflation rate, the rate of change, went down precipitously. And that's what was one of the principal causes for that secular bull market in all financial assets during that decade.
I know you're extraordinarily well equipped to answer this. We talked about copper yesterday on Fast Money, or on Wednesday. You're listening to this on Friday. The CRB index, the recent high in the CRB was in the summer of 2008. I think it traded either side of about 450 or so. Let's just round it off. Recently, obviously, it's sort of at the peak of COVID. This is something that traded down to about 125. As we're sitting here today, David, the CRB index, which is different than the Goldman Sachs Commodities Index, is trading at levels we haven't seen since, I want to say, the winter of 2011. So all these underlying commodities have been getting on their horse, led by copper. So there's something going on. Now, you can explain it away and say this move into commodities is just people trying to get ahead of tariffs, and maybe there's some of that going on. But I look at this and say, we may think inflation is under control, and everything you said is right, but the commodity market is seemingly telling a bit of a different story here.
Well, look, if you look at the historical chart of the CRB, it looks like a series of sine waves. It wasn't that long ago we were talking about how depressed the base metals are. Now they've picked up. We're complaining about egg prices. Egg prices have rolled off their highs. In some cases, commodities move because of geopolitical events, or they'll move, of course, like you're saying, getting ahead of the tariffs. I think in the case of copper, that certainly is the case. But rarely do they move because you're getting a sudden shift in global demand. Now, that said, a couple of things have happened, and commodities do have a very large speculative element to them. So there's the tariffs, but there's also more Chinese fiscal stimulus. And you hear Chinese fiscal stimulus, and one of the first things you're going to buy are commodities, because China accounts for half of all the world's consumption of commodities at the margin. So I think there's a response to that. And something else going on very significantly, of course, is the fiscal bazooka that's happening in Europe right now, led by Germany. And, when you're talking about not just military spending, but infrastructure, well, infrastructure takes a lot of basic material. So there's part of that as well. So that aspect of it, yeah, you could say that would be modestly inflationary, but what's really, when you think of all the thousands of items that go into the CPI or the PC deflator, and the majority of them are services, like the United States in particular is a service sector economy. Like between 70 80% of the US economy is services, it's not goods. And where are you really going to trace copper or nickel, or tin or lead, into final prices at the consumer level? It's really infinitesimal. So, no, I'm not too worried that there's going to be a big inflationary impulse. And then on top of that, when you're talking about the consumer, what's the most important commodity of all, and for businesses, is energy. And oil prices are pretty depressed. When you're taking a look over the past 3 months, 6 months, the past year, I mean, I was hearing a year ago people talking about $100 oil. We're nowhere near that. And that's really the most critical resource. You're talking about something that everybody has to use. Honest to God, I've never gone to the local hardware store and asked the proprietor if I could buy a pound of copper to bring home to put on the mantle, okay? But we all consume energy, and energy feeds into everything, right? Oil feeds into everything. Copper does not feed into everything. And there's not really much of an inflationary impulse coming from the energy sector, and that's really much more important.
Rosie, I don't know if you're watching Landman, but you sound a lot like Billy Bob Thornton there about the energy. Have you seen that? It's an amazing show. And there's a bit that he does when they're walking out to one of the drillers, and he goes, he just rattles. Like, God, you loved that.
That's a great. Rosie, if you haven't seen it, you
should. You got to watch that, because there's that one bit. We'll find that and we'll send it to you. All right.
I'll watch it between commercials during the NHL playoffs.
There you go. Now this one's a good one. This is you carve out some time for this.
Time, yeah.
All right. So you come on Fast Money a lot. You've been doing our pod for the last few years. You have been steadfast in the camp, and you just kind of walk through your view on inflation, and you thought it was always coming down. So let's talk a little bit about the thing that might kind of cause it to go in a direction that most folks don't think it could happen, I guess, at the speed in which I think if these two things happen. Okay, so think about it this way. Trump tweets this out. You saw the tweet, right? The Fed would be much better off cutting rates as U.S. tariffs start to ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. All right, so let's start with the idea that the Fed were to be pushed into lowering interest rates, and that April 2nd, we're going to have trillions of dollars in tariffs that's going to slow global growth in a meaningful way. What do those two sort of ideas mean to you? If the Fed were browbeat into lowering interest rates and they were going to have an extended trade war?
The question is, what is meant by the word transition? So if we transition into a recession, we transition into a multi-month period where it's not even a recession, but the economy is slowing well below potential. And that basically means that we're building up more spare capacity in the economy. And we'll see that, of course, in the various measures of the unemployment rate. They'll be cutting rates, but it's a question of be careful what you wish for. So if the Fed is going to be cutting interest rates, it's going to want to see that after the tariff shock, inflation expectations are not becoming unmoored. He dismissed some of the inflation expectation metrics that have been making the headlines lately. I was impressed by that. I hope he's right. But he's going to want to make sure that inflation expectations, whether in the survey data or in the markets, are staying contained after we get these price shocks. Now, there's no doubt in the world that the tariffs are going to cause an initial price shock that could last several months. The Fed has already told you they're expecting that. That is in their numbers. The question is going to become how much is the economy weakening, and the extent to which that weakening creates more excess capacity or supply in the economy, because that'll be a very important signal to the Fed that the inflation shock is not going to be persistent. And then they will respond by cutting interest rates. It's really just a matter of what the timing is. They're not going to be raising rates. They're still committed to cutting rates. Their dot plots are 2. I actually think that they'll do more. And what we should probably do is just take a feather out of the cap from 2019. 2019 was peak tariff year at Trump 1.0. Wasn't nearly as broadly based, was targeted across products, and it was really mostly against China. Canada didn't really, or Mexico, factor in that much. This is on a much bigger scale. But if you remember, we also came off the $1 trillion tax cut, which really cushioned the blow for the economy heading into the tariffs. Remember, he eased fiscal policy first, 2 ways: cut taxes, but program spending, ex-interest government expenditure, before COVID was rising under Trump 1.0 at over a 4% annual rate. Well, right now, program spending is facing the knife. We don't have a tailwind from tax cuts. If we get them, that'll come much later. We have the tariff uncertainty, which is actually much more acute than it was, say, in 2019. Now, we went to 2019, not with the dot plots or the markets expecting 2 rate cuts. We went to 2019 with the dot plots calling for 2 rate hikes, and the markets priced for 2 rate hikes. And what ended up happening was the Fed ended up cutting rates 3 times in the final 4 months of the year. Now, they waited. Just like now, they're in wait and see. They were in wait and see. And what did they wait and see? Now, remember, that's a pretty big delta. Going in expecting 2 hikes, and they cut 3 times. That's 5 moves, 5 rate moves that were not anticipated at the beginning of 2019. And what the Fed saw by the end of the summer was that there was no lasting inflationary impact, but it also saw why was there no lasting inflationary impact was because we had a recession in business capital spending in the second half of the year, and we had a recession in the production sector of the economy. The consumer kept on going because it had the cushion from the tax cuts that were implemented in 2018. That was a gift that kept on giving. So there's no such gift that's giving this time around. And the government spending side is going to be a serious source of restraint on the economy. The question really is going to be magnitude. They could be easily cutting interest rates by the time the summer rolls around. And I think they'll be cutting more than 2 times. It's one of the reasons why I'm still steadfastly bullish on the Treasury market, because that's not fully priced in. But I think we can learn a lot. I think we can learn a lot from that episode.
So, Rosie, it is amazing to go back and look at the success in which they kind of navigated tax cuts first in 2017, and then they kind of got into this trade war. And to the points that you just made, it wasn't just corporates, but it was consumer that had the tailwind of the tax cuts, right? So when I think about what's gone on over the last couple of months, I say to myself, they've kind of done this ass backwards, right? They could have actually had some of the same success if you think of the sort of economy that they were handed over, right? And again, whether it was strong and weakening or what, it's here nor there, but the tax cuts would have actually had a positive impact on corporate earnings, on CapEx spending, on a whole host of other things, right? So now you think about it at this point, they've kind of gotten themselves backed into a corner. I'm trying hard to think about how this economy stabilizes or inflects higher, even if on April 2nd we hear a bunch of exclusions from the tariffs and the like here. I just don't understand what would be the conditions in which we were going to get back above expectations for growth, at 2.5% or whatever we were running at last year in 2024.
I share your pain, brother. And it's like the short-term pain for long-term gain, but we live in the short term, and Keynes told us that we're all dead in the long term. So I would say that I don't remember the election campaign being fought on pain or transition. The top three voter concerns during the election campaign: inflation, the border, and healthcare. Trade and tariffs were low down on the list. And I really thought that this trade war was again going to be taking the gloves off against China, and we're in a long-term secular economic war with China, and that's where the real cheaters are. I didn't think that Canada, for example, was going to feature as much, and that we would be, pulling on an attack on the North American supply chain. That really caught me by surprise. So yeah, the thing is that to some extent, the previous administration sort of left the next government, whoever was going to be, in a bit of a fiscal straitjacket, because if you want those tax cuts and you don't want to face a possible credit downgrade, remember what happened in the summer of 2011. And back then we only had one of the rating agencies, S&P, cut the U.S. from AAA, but Fitch and Moody's didn't. But you get two of the rating agencies cutting your credit rating on the reserve currency. I mean, that's going to be serious dislocation for capital markets. So they have to find the cost savings first if they want to embark on any future tax relief. But you see, what I would have probably done first was try to reduce one level of uncertainty that is going to come back at some point second half of the year, which is the sunsetting of some major provisions, especially for the household sector, from the 2017 tax relief bill. That's the first thing I would do, is try, especially when you consider that this could dominate the midterms next year. We could be falling off the fiscal cliff if those tax cuts sunset. It'll be really bad news for the economy. I would have done that first. I can understand, getting rid of waste and abuse and fraud. Who doesn't want that? It's just really unknown how much savings are going to be there. The estimates are wild, and not just wild, but extremely politically partisan too. I just don't have a good feel for that. But I'll just say that I tend to agree with you. Most important thing is this, and this you can see in real time. There are measures of uncertainty, and you can get data going back decades on economic uncertainty, trade uncertainty, and policy uncertainty. And we're in an orbit we've never been before. You're talking between 3 and 5 standard deviation events on classic measures of uncertainty. And if you go, once again, I want to go back to your first question on Jay Powell after the FOMC meeting. What was one critical number? We talked about GDP, we talked about core PCE, we talked about the unemployment rate. We didn't talk about one specific number, which was the number of times Powell mentioned the word uncertainty at the press conference. 19 times. 6 weeks ago, it was 17 times. Back in September of last year, before the election, uncertainty was mentioned once. Of course, it's always going to be mentioned because we're always in an uncertain world. But let's face it, we are in an uncertain world on steroids. And, the first economist of acclaim that modeled uncertainty in GDP forecasts was John Maynard Keynes. And we've done that. We have modeled uncertainty in our forecasts. You can do that. Now, like any other forecast, wide error terms. However, there's a base case. And do you know that just that level of uncertainty right now in the economy is so acute that if it's sustained, this alone, this thing that you can't see, touch, or feel called uncertainty will drain 2 percentage points alone off of the baseline trend in real GDP, which right now is 2.5. The uncertainty alone takes you to 0.5, not 1.7. So what happens with uncertainty? With uncertainty, what happens? And you're seeing it actually in these earnings, post-earnings CEO conference calls. What happens when you're a business and you're in an acute state of uncertainty? Well, you do what Jay Powell is doing. Jay Powell just told the world, we're standing still. I'll tell you right now, if it wasn't for all this uncertainty, the Fed would still be cutting rates. They're still like 130 basis points above neutral, but they feel the need to stay restrictive right now. So he's telling you that I'm in a dark room and I'm not moving. That was the analogy that he was using. That was the metaphor. You're a businessman, businesswoman. What are you doing? You're standing still. CapEx plans, you see it in all the survey data. CapEx plans are being frozen. You just saw it in the Philly Fed Index. The 6-month expectations on CapEx plans rolled over this month in a major way. CapEx plans, what you want to do. What do you want to do in uncertainty? As a business, you build liquidity at the expense of capital spending. A household, what does the household do in a state of uncertainty? What do? You build precautionary savings at the expense of what? Discretionary spending. So that's what happens. That's the uncertainty alone. The uncertainty alone that's been created is it's very damaging to the outlook. Now, I think the administration is saying, well, this is part and parcel of this transition, and we're going to build a better future.
Well, they've made that clear, and they've talked about how, there's going to be this period of time where you're going to have to I'm paraphrasing, suck it up. Couple things, in terms of the potential for a credit downgrade, which you mentioned, and I don't think you think that's imminent, but that would be, I think we all agree, extraordinarily bearish for the bond market. I think yields go higher under those circumstances. But you mentioned CapEx, and so much of this rally, especially in semiconductors, has been built upon this thought or these promises of CapEx in numbers we have never seen before historically. So in your opinion, and you just addressed it in terms of the Philly Fed and Philly manufacturing numbers, but what are the chances that the CapEx that was going into the AI trade sort of get ratcheted back? And what, if that happens, is the impact on the market?
I think that was happening anyways, because just as ChatGPT, in late 2022, I mean, that helped end the cyclical bear market back then. Then you had NVIDIA's blowout results, and that was a major inflection point. I think we'll go back and say that DeepSeek was another inflection point, that the belief was that there were significant barriers of entry into these GPU chips, and DeepSeek just said, no, there's actually barriers to entry or not what was being discounted, and we could do it faster and cheaper. And then all of a sudden, you have a lot of second guessing as to whether or not we've already triggered that overinvestment. I've been talking to Jim Grant, and that's, if you ask him what his biggest concern is, it's that we've already done what we did with fiber optics, back in the late 1990s. Now, we never know these things till after the fact, but the case can be made that we've already had that overinvestment, which usually happens when you have an inflection point in the innovation curve. You get it. I'll go back to the railways or the canals. I mean, this is just the nature of the markets, and investors plow in, and you get the capital spending, and we overinvest. And tell me that these high-flying tech stocks that were driving the market in the past 2 years, look what they've done over the course of the past few months. I think the market is actually telling you something, irrespective of the tariff and trade war, that we've already had this classic overinvestment in this space.
Well, so Rosie, it's funny that you mentioned ChatGPT to DeepSeek, and let me throw another one out there for you, CoreWeave. This is a company that 3 or 4 years ago had $20 million in revenue. It was a ether mining company in New Jersey. They repositioned their GPUs to kind of create data centers for training large language models. NVIDIA invested $100 million in them at like a $2 billion valuation. They bought probably $100 million worth of GPUs from NVIDIA over the course of the last few years. The company's revenue has been growing dramatically. Microsoft is a 62% customer of them. They've taken out $13 billion in debt to fund this build out. They're going to go public. JP Morgan, Goldman Sachs, and Morgan Stanley are leading this. A couple weeks ago, we hear that Microsoft is kind of delaying some leases in the data center, that the 3 founders of this company have sold $500 million worth of stock in the last year. In 2023, some of the largest shareholders in the private market, I think Wellington was one of them, they sold $1.5 billion worth of stock. So this thing is going public. They have 2 customers that are 77% of the revenues. Who the hell should be buying this stock on an IPO, to be very clear? So there's tons and tons of hair on this thing. That could be another really important footnote. That was a little rant. I just want to make sure you know that's coming. So I want to build on what Guy just had to say on the CapEx front. When you think about the sanctity of those numbers, we've been just kind of shocked that people are like, take it to the bank. Microsoft's going to spend $80 billion, and Amazon just raised theirs from $57 billion to $90 billion. That's over the next year. Again, if things slow down, if there's not demand for these products, they're going to cut those costs. But here's the problem. If they were just getting leverage out of those cuts because the economy is doing well and they basically have some pricing power, fantastic. But that's not the likelihood. The likelihood, to your point about fiber optics, is that they've overbuilt, right? Sort of capacity. And the other thing is, when you look at Google and you look at Amazon and you look at Meta, they were all trading at all-time highs into their prints. And then they had a slight deceleration, not Meta, in their revenue growth. And the stocks are down 20% in a straight line. And I think that has a lot to do with what the market's done. So can the market, this S&P 500, can it stabilize without, we call them the Fateful Eight, we threw Broadcom into the Magnificent Seven. Can they stabilize without the prior leadership participating? And just give us a sense of where you think the S&P 500 is in the next 6 months, 12 months.
Thank God I'm not a sell-side analyst anymore. I'm not going to give targets. I would, in answer to the last part, if you normalize the multiple, and I'm not even saying into a recession, the historical multiple under the interest rate landscape we have today is about 17 times. Now, I'm looking at the overall market. I know people like to strip out the Mag 7 to prove their point, but the market is the market. And, stripping out TMT back in 2000 didn't really get you anywhere. The market is the market. And then you throw in, say, a recessionary forecast on earnings, you'd get more than a 30% pullback in the market, like not 30, more than 30, but I don't really want to depress anybody. But that's how I personally am positioned anyways. I'm positioned not zero in equities, but the lowest representation I've had since probably 2007. Yeah, I would say that can the market survive? Well, you've seen what's happened this year, and the market's down. It hasn't collapsed, but at one point, just last week, we were for a day in official correction terrain. And you are seeing, if you had that trade on being long the S&P 500 equal weight and short the cap weight, it's not been a bad trade. They're both down, but the cap weight is down more. And that's still, I think, a very good trade. But what happens is that, and it's not like the rest of the market outside of, say, technology is in a bubble, but there's only 2 sectors, and we're talking healthcare and energy, and maybe real estate, which is a tiny share, that are trading at multiples that are anywhere close to their historical norms. So when I hear the point that, well, the only excess overvaluation is in tech, no, it's actually in actually 8 of the 11 sectors, you're trading quite expensively. And we know the lessons from what happened after the tech bubble burst in the early 2000s is that the S&P 500 actually held up for a period of several months. Like, the tech stocks peaked in March of 2000 and the broad market peaked in September. It just told me the story was not, wow, look how great the market's holding in. You're buying equities, you're taking on the risk to make money, not to stay sideways. So the market stayed sideways, and then the whole thing went down. Even the most defensive sectors went down. It was a matter if you were a long-only equity manager and you got paid for relative performance. If you were in the more defensive areas, you did fine. But the whole market went down. So no, I don't believe that the market is going to hold up indefinitely, because I think that everything is correlated with each other. Like, there's an economic signal here on the economic outlook. We're talking about capital spending. Well, that's going to come down to a whole bunch of other things in terms of how that spending affects other sectors. And then how does it affect the job market? And then there's going to be knock-on effects. So you don't look at the fact that these high-flying tech stocks have rolled over, and then the question is, well, can the rest of the market survive? It can survive only for a while, because there's going to be multiplier knock-on effects on other parts of the economy and the capital markets. So this is actually, if that's your belief and you've been in other parts of the market, you sort of want to clean that up if you're overweight the stock market to begin with. I think you want to clean that up and turn more defensive. That would be my my major point. Not that the market holds up. I think that will be temporary. Now, temporary is months. Like I said before, tech stocks peak in March of 2000, and the market held in wonderfully for 6 months. The rollover in tech stocks was a leading indicator for what was going to come in other sectors of the market. That's the point I'm making.
Yep. And listen, it's well taken. I mean, look, if you look at it, Dan, I know you know this, and we'll wrap. Semiconductors topped out in July of last year, so your math lines up really well. It's always an honor to have you join us, David Rosenberg. You'll be back again soon. I know our listeners and viewers love when you're here. Your thoughtful responses are well worth everybody's time. Thanks for joining us.
And by the way, we also love it. And one of the first reads I have every morning is Early Mornings with Dave. That's at Rosenberg Research. So if you want to be, just kind of dialed in what Rosie's saying every morning, go to Rosenberg Research and subscribe. It's a great read. So David, thank you so much for being here with us again. We hope to see you really soon.
Great. Thank you guys very much.